tutor in the Colette Tutor Lab located in the Colette Business School. You can reach us at colettetutorlab@uab.edu, or you can contact us on Skype at Colette space tutor to arrange for a personal Skype session with a tutor who is available. We're going to cover Chapter 10 today, which covers long-term liabilities. Chapter 10 has its primary focus on long-term liabilities. Sorry about that. These are liabilities that have a life longer than a year or longer than one operating cycle, presumably whichever is longer. Again, I don't know anybody that has an operating cycle longer than a year, as I talked about it in Chapter 9. The majority of the chapter, however, deals with bonds, so that will be where we focus. Bonds. An issuer's written promise to pay an amount identified as par value of the bond with interest. Par value of a bond, also known as the face amount of the bond, is paid at a specific date known as the bond's maturity date. In addition, most bonds require the issuer to make semi-annual interest payments, which are computed by multiplying the par value of the bond by the bond's contract rate of interest for that same period. Bonds have numerous advantages over equity financing. Some of those are the three primary main advantages of bond financing is: one, bonds do not affect owner control. If you had financed using equity, that would affect your owner's control. Interest on bonds is tax deductible. Bonds can increase return on equity. If you are earning a higher return with your borrowed funds, then it pays an interest on those funds, increases its return on equity. This is known as financial leverage. That's kind of confusing, but basically what it means is if you're earning more money off of the money that you are borrowing off of your bonds that you've issued than what it would cost you to go borrow that money elsewhere, then you are actually earning return on your equity. Disadvantages of bond financing. There are two main disadvantages of bond financing. Bonds can decrease return on equity, opposite effect of advantage number 3. Bonds require payment of periodic and the par value at maturity. This can greatly increase the cost of financing. Say, for example, you have a bond with a face value of $100,000, 10% interest paid out over 10 years. Your cost on that is basically going to be $1 million in interest and $1 million on the day of maturity when you have to repay the par value. So you can really get yourself in a hole quickly using bonds as your means of financing if you're not careful. We're going to talk about the straight line method for amortization of bonds. The straight line bond amortization method allocates an equal portion of the total bond's interest expense to each of the bond's semi-annual interest periods. Issuing bonds at a premium. The amount by which the bond's price exceeds par value is the premium on bonds. Issuing bonds at a discount. The amount by which the bond's price is devalued below the par value is the discount on the bond. This is going to pretty much complete what I'm talking about as far as definitions for bonds. There's other stuff in the chapter that the chapter does really well as far as explaining. One thing I do want to talk to you about is operating and capital leases, because these are areas where companies actually in the past have manipulated their leverage ratios by having what is effectively a capital lease but calling it an operating lease. Because as you can see, a operating lease is a short-term or cancelable lease in which the lessor retains the risk and rewards of ownership. The lessor is the person who is renting the item out. The lessee is the person who's renting it. In this case, you, the company. Examples include car rental agreements or apartment rental agreements. The lessee records such lease payments as expenses. The lessor records them as revenue. See the journal entry below. This is from the lessee's point of view. He is saying, I paid rental expense of $300, so I am going to debit rental expense, which we all know increases your expense, and I'm going to credit cash, which as we all know decreases cash, $300, and that's the entry. And what that does is that puts all of the risks of ownership on the lessor, and in this case the lessor actually is the one taking all the risks here, because you can just walk out of this agreement at any time. Now, what was happening though is companies were taking these leased assets as capital leases and reclassifying them as operating leases as if they could walk out of them at any time, when in actuality they would have negotiated side deals on it that kept the cost off their book. Because as you'll see when we get to capital leases here, the costs are pretty substantial over the course of a year. The example I'm using is a 6-year agreement for leasing a building on a capitalized lease. Capital leases are long-term, non-cancelable leases by which the lessor substantially transfers all the risks and rewards of ownership to the lessee. Examples include airplanes and retail buildings. The lessee records the leased item it has as its own asset along with a lease liability at the inception of the lease term. See the journal entries below. You start the lease on January 1, 2013. Your leased asset building, you are debiting that for $60,000. So that is an asset. Debiting it increases its value. Lease liability is a credit side, so we're raising the liability of our company by $60,000. To record leased asset and lease liability, this is from the lessee's point of view. On 12/31/13, you have to then take out the depreciation expenses for the building. Depreciation expense for the building is $10,000. Accumulated depreciation on the building for the first year is $10,000. Again, depreciation expense is a debit side entry to raise it, and accumulated depreciation is a contra asset, which means you use a credit entry to increase the size of the accumulated depreciation. Then on 12/31/13, you also have to record the cost that you have to pay for leasing this building. So your interest expense would be $4,800. Your lease liability would be $8,179. That is increasing your expenses, reducing your liability, and decreasing your cash for a total of $12,979. Debits have to equal the credit in this case, which they do, and this is to record your first annual lease payment of 6 planned payments. This is from the lessee's point of view. I'm going to work a couple of problems in Excel with you on discount bonds. In your textbook on page 430, Exhibit 1012, there's a discount bond being shopped by Fila, a shoe company. Cash flow on that is $100,000. That's the par maturity value. You would use table B1 found in your textbook. Your present, oh my goodness, I can't believe I put present value factor. That's supposed to be present value factor. Again, I'll just apologize and say I've been doing this for quite a while now. A little punch drunk at it. So you're looking at present value factor is 0.8227 according to the table located on B1. When you multiply the $100,000 by the present value factor, that would give you a total present value cost of $82,270. Then you would go down here to the lease payments or the interest payments, $4,000. Table B3, 3.56 times the 4,000 would give you a present value of $96,454. That would be showing that because you are doing this at a discount, that means you're offering your bond at a price lower than what the market says it's worth. So to induce people to buy your bond, you allow them to pay you less than the face value of the bond of $100,000, and you take a $96,454 payment in return for the interest that you're going to pay and the $100,000 that's on the face value. So it's going to cost you $114,000 to get that $96,000 of financing for your discounted bond. On page 430, Exhibit 1030, Adidas, another shoe company, is shopping a premium bond. Its face value is worth $100,000. It tells you to use table B1, which gives you a present value factor of 0.8227, same as above. Multiply it times the face value, and you get $82,270, just like up here. Because you also are paying $6,000 in interest payments. Table B3 gives you the same number as it did up here for the present value factor of a discount. You multiply that times the interest amount, and it tells you that you earn $21,276. This tells you that you are going to pay, you're going to get an extra $300,546 for what your $100,000 face value is. So you're going to collect $103,546. Now, on that page, off to the side, it has instructions for how to do these with a financial calculator. You can't really see it because it's dark. It's not showing up well against it. But this is a Texas Instruments BA2 Plus financial calculator. So the first thing you want to do when you're setting your calculator up is you want to press second, which is the yellow button on your financial calculator, and you want to press the payment key, because its second is setting your adjustment for whether you're getting interest at the beginning of the month or at the end of the month. You want to make sure you have it set up for getting those lease payments or getting those interest payments at the end of the month. It then tells you that if you enter the following numbers into your calculator, it'll do the same thing for you that those tables did, but a lot less complicated and a lot faster. So you would enter N, which is the number of payments, 4. You would enter your interest rate at 5%. You would enter payment at $4,000. You would enter future value at $100,000. And excuse me, on the payment, you would actually enter that at -4,000. You would then ask it to compute the present value, and it would give you the same number that we had over there, $96,454 cents, or $96,454, and actually it has 5 cents. You round it down because you always round to the nearest dollar. On the premium, which is for Adidas, again you enter number of payments that your interest payments you're going to make is 4. Your interest rate is going to be 5%. Your payment is going to be -6,000. That's just to make the calculator work the number out at a positive, because if you do it otherwise as a positive, it will come out as a negative number. You would then hit 100,000 for the future value of that, and you would ask the calculator to compute the present value, and that would give you the $103,546, and it actually is $103,545.95. So again, rounding up. And if you notice, that nickel from above comes down to the one below so that they still equal out at the correct amounts. It's been my pleasure making these videos for you for chapters 1 through 10 for your online AC 200 class. Again, my name is Dennis Brooks. I'm a tutor here at the Colat Tutoring Lab. You can reach us at colattutoringlab@uab.edu, or you can reach us on Skype at colat-tutor for an individualized tutoring session on Skype if you wish, or if you have questions. I'm going to bid you farewell on this. I wish you all the luck in taking your final exam, and I hope that these videos have been helpful to you as you've progressed through your professor's online class.